All right, this is Robert with Seeking Alpha and GoldSilverPros.com, and I have here Tan Liu, who has written the book, The Ponzi Factor, and he has a very interesting argument in the book around the stock market and the underlying value of the stock market. Tan, how are you?
Good. Thank you, Robert.
Well, thank you for joining. I really do appreciate the time you've given. I was hoping that you would give us a few minutes and describe what the book is generally about and the reasons why you wrote it. Sure.
So my background is I have degrees in economics and finance and a master's in statistics. And I worked in finance for about 10 years. Initially, when I started my career about 10 years ago, I was just like any other person that loved the stock market, loved the finance industry, and I started my career in a hedge fund. But in the first 2 years, I realized in one of my hedge funds that a lot of these synthetic assets, whether it's a stock, life insurance, or option or derivative, the way that people make money, real money, not an asset value, but real money, is essentially by taking it from other investors that are contributing more money into the system. And one of my first experiences at a hedge fund was where they used accrual accounting to basically prop up the price of a stock based on valuations that they created in their model. Oh, sorry, not a stock, but a synthetic asset. In that case, it was a life insurance policy. So they value these things with their own model, and they essentially recorded profits according to their own valuations, which is what they will be worth in 2 years. During that 2 years, they recorded those profits. The problem is when it was time to sell those assets in 2 years later, those assets weren't worth as much as they projected. So what do? They bought the assets back with their own investors' money from a different fund to justify their previous assumptions. And what they did was completely legal, as in they valued their own assets, they priced them up, they recorded profits for 2 years, they sucked in a lot of investors, and at the end of the 2 years, when they couldn't get the price that they wanted, they figured out a way to just buy it back themselves with another fund. And essentially that opened my eyes to how the finance system works and how this whole idea of creating money with creating stocks, instruments, and basically shuffling it with synthetic assets is not real. It doesn't work. Where you get the money from at the end of the day is from another investor. And that's kind of how the similar is to the stock market without dividends, because a stock that doesn't pay dividends doesn't actually receive money from the company that the shares belong to. So the shareholders essentially for non-dividend stocks, whether it's Berkshire, Google, Tesla, never get paid from Google, Tesla, or Berkshire. There's no monetary connections. This is also why we can clearly observe Tesla stocks rising from $20 to $380, while the company itself lost over $6 billion over 8 years. And we can also observe events when Google shareholders could hold the stock for 4 years, make nothing, while Google reported $28 billion in profit, or periods of 3 years for Berkshire when investors made nothing because the price didn't move, and while the company made $50 billion in profit, or reported $50 billion in profit. So the fact that these scenarios exist is evidence that there is no monetary connection between these shares and the company itself. Because what makes the price of a stock move is not how much money the underlying company is giving you. It's the exchange of money between investors. And a system that exchanges money between investors where current investors' profits are dependent on cash from new investors is by definition how a Ponzi scheme works.
So aren't there instances in which companies will provide dividends or provide value in some other way that helps support the stock prices?
Dividend stocks are totally different. Yes, for dividend stocks, it's totally legitimate because there's a monetary connection. The investors are actually making money from both dividends and capital gains because the company itself is actually paying the shareholders. Now, the value part, we can speculate all we want about how non-dividend stocks have value, but at the end of the day, the basic logic is, why do they have value if the companies, the owners don't receive any money from the companies they own?
Okay.
Right.
And I think one of the things that you mentioned in your book and in some of the interviews that you've done is that most companies don't pay dividends, and so the value of the stock is really what the next person is willing to pay for it. So let's say, you know, there's an Apple share that's out there for $200. I think that you use is $208, and I'm willing to pay $210 for it. I've increased the value of that stock by $2. But not only that stock, but all of the stocks in Apple's portfolio. And if you'll talk a little bit about how that works and volume and how that may be mispricing the actual asset.
Sure. This element was this particular example was not actually in my book, but this is something I will put in my next book. It has to do with the market cap formula, and which is also similar to the total returns formula that's used in equity risk premium research. The market cap formula is quite simple in terms of it multiplies a price by the total shares outstanding. In Apple's case, they have about 4.8 billion shares outstanding. And the price component is where it gets a little funny, because the price people don't quite realize is that is really achieved with just a handful of shares. It could literally be maybe 1,000 shares or even one share. And the price is being applied to 4.8 billion shares. So if Apple is trading, let's say, $208, and you go into the market and buy one share of Apple for $208.01, contributing just one more penny, right? What happens to the market cap in Apple? That 1 penny, basically 208 and 1 penny, let's just focus on that 1 penny. That 1 penny will be multiplied 4.8 billion times. So Apple shareholders in their combined portfolios will see an increase in valuation of $48 million, even though you just went in there and bought one share for 1 penny more than the last traded price. So what it shows is there's something very fundamentally wrong with the market cap formula itself. This formula, by the way, was developed by some guy named, I think, Edgar Smith back in 1920s or something like that. And the problem is, you know, good for him for developing a new formula, but the problem is no one checked it and we just started using it. And the biggest misconception right now for people who think they're making money from stocks, especially Warren Buffett, is that $34 trillion of stock value, or even $4 billion of stock value for Apple, Google, Berkshire, is equal to $0 in real money. At the end of the day, people want money. They invest to get money. It doesn't matter how much the value is in their portfolio. What matters to them at the end of the day, investors, is how much money they'll get for it. And it's and apparently a lot of people can't realize this, as in they all know stocks aren't real money. They all say that, but they all have a serious problem saying, well, if I have $10,000 in my stock account, I have $0. They have a very big problem saying the latter, even though it's an equivalent, logically equivalent statement even though it's an logically equivalent statement between stocks are not real money, and if I have $10,000, I have no money in my account.
Yeah, I really don't think that people really want to realize that, even if it's the truth. But going back to one of the points that you first made there, you said that you know, not many shares are exchanged. So I believe in the example that you talked about in the video, I'm sorry, not in the book, but in the video, was that it maybe only 1% of all of the shares on the stock market are trading on any given day. So that's relative illiquidity, really, in terms of how much is trading. So how do we go about actually understanding what the stock market is worth? Is it possible? I mean, would it have to be everybody puts up their shares for sale at the same time, or how is there any way to determine it?
Yeah, that's a good question, right? I mean, because I did point out a serious flaw with the market cap formula, which is you can't apply the price that's achieved from roughly 1% of the shares outstanding that's being traded to 100% of the shares. And some people will say, oh, isn't that the same as everyone withdrawing their money from a bank? No, not at all. Okay, I'm just going to address this real quick. Where no, one is buying and selling an asset in the market. Another is depositing and receiving something. And the people who are borrowing your money in a bank, they have to pay it back. Whereas the stock market, not the case at all. So the point is, they're different situations. With respect to the market cap formula itself and the flaws I pointed out, I've actually thought about this quite a bit. And unfortunately, I do not have an answer. I simply pointed out that this is a seriously flawed formula when someone can buy one share of stock for 1 penny more and then have 4.8 billion shares multiplied by that penny and increase everyone's value by $48 million. I will have to say that if there is a formula that exists in how to value it, it would have to take into account the probability of actual liquidation, where based on the 1% assumption, also something we could clearly see, that would have to be taken into account. I don't want to get too abstract, but the thing is, if we actually do take the liquidity into account, like such as the 1%, the problem is Apple shares will no longer be trading at 208. Basically, the factor of liquidity, the probability of liquidating, based on current scenario, it would be applied to the 208. But if people know that that's being applied to the 208, then the 208 wouldn't be a 208. so it's kind of a circular issue. Like I said, I don't want to get too abstract, but the bottom line is, no, unfortunately, I don't have a better answer for how we can value it. Unfortunately, the market cap formula, though, however, is grossly wrong.
Right, and it sounds like you're describing a painting by M.C. Escher where you see the guy walking up the stairs, but you can't find the origin of the stairs. It seems like it just goes up and up and up.
Yeah.
And where's the base of that stairs? It's sort of an illusion. And the question is, and I think it's a very interesting point you bring up. If we don't have ready tools available that investors commonly know about to value stocks, that's a problem in and of itself. If we can't just go out and apply XYZ formula to a particular company stock and even more broadly to the market, then I agree with you. Then we have issues there, and we don't really know what the true valuations are.
Yeah, I will add one thing from basically. I think I published a video maybe last August or September, and I've always think about these things continuously. Right now, my best answer to that question is actually just the fact that we're not supposed to do this. As in, we're not supposed to trade these things like basically Ponzi assets that they are. Initially, ownership of stocks, and goes back to history, which is a very important part of my book, is that you buy a piece of a company and then you receive dividends. You own a piece of a company, they make money, they share the profit. That's how it's supposed to work. And that you can value a stock pretty easily, or the share of the stock pretty easily, because you just go with the dividend flows in the future. Basically, the dividend discount model is what they use in finance. It's very easy. Basically, your cash flows are based on the dividends that the company's going to pay you. That's also very logical. This capital gains aspect, where we just start buying and selling and ponziing up the price to whatever it is, this was never meant to be like the essential component in stocks. And essentially, it's not supposed to work like this. So on one hand, your question was, how do we value it? On another hand, we also have to take into consideration that this capital gains aspect that we are wondering how we can value is actually something that wasn't supposed to be, according to history. So really, my best answer, aside from I don't have a better formula than the market cap formula, is it may not exist because it wasn't supposed to work like this.
Yeah, no, that's a really good point. And I want to move forward in the conversation, but I want to back up just a moment before we move forward. Backing up to how do we value a company. In the past, I've had discussions with people, on Seeking Alpha or just financial professionals about how you value a company, its liquidation value. And they'll quote me book value. And they'll look at like property, plant, and equipment. And then, of course, you have to take out goodwill, because what is goodwill? It's sort of an abstract concept.
Yeah.
But the problem with property, plant, and equipment that everybody also tells me at the same time is, I'm like, okay, how do you value that? Because it could be in different states of depreciation. And it just depends on what someone else will pay for it. So if we
Yeah.
take an example, let's say you have a mining company that has produced a mine and built a mill in some remote location, and they're winding down that mine. Well, their property, plant, and equipment could be worth a lot, but the location,
Mm-hmm.
you may not have a use for it there anymore. And so you have to subtract costs of somebody willing to buy that equipment and move it somewhere else to where it can be useful. So there's not even an easy way to look at book and liquidation value, I don't think, for different companies. And so I think
Yeah.
it's this really hard argument where it's really what the market will bear at any given time, but it's all speculation on what that market will be at the particular time that company, that you need
Yeah.
to value that company.
Yeah. Furthermore, let me also add the whole liquidation thing, right? Timing also matters. I mean, as in, when's that going to happen? Even if a stock is, let's say, legitimately backed by the underlying asset, and even though, let's say, Google, well, this is not what we know, but Google clearly doesn't pay dividends, right? Let's just assume that someday down the road they'll liquidate, and when they do, they're going to give shareholders everything that their assets are that they're holding right now. Question is, when is that exactly? 100 years from now, 1,000 years from now? And during that time, it's just going to be a Ponzi asset that's just continuously traded and they just don't pay their investors, right? I mean, so it's kind of like, even if liquidation value, even if the assets are somehow are connected and backing the underlying thing, if that never happens, or not never happens, but it doesn't happen in any foreseeable future, then it's kind of irrelevant, because until then, the people who are buying and selling their stock is receiving nothing from the company. So that's really kind of interesting, another aspect of it too.
Yeah, that's a really good point. And kind of moving forward, you mentioned a couple other things. You mentioned accrual accounting, and this is one area that really got me interested because I have a little bit of accounting background. I have my bachelor's is in business, and actually before I went into technology, I started in accounting. And one of the things that I couldn't quite grasp was all the different tricks they use in accounting to sort of try to value things that aren't really concrete, more abstract. Yeah. So could you talk a little bit about accrual accounting and how it sort of plays into this?
Yeah, so this was essentially what opened my eyes to a lot of the dirty stuff in finance. Accrual accounting, basically you value an asset based on what it will be worth in the future. And until then, you can kind of report profits based on what it will be worth in the future. The problem is you don't actually know what will happen in the future until the future is actually there, maybe in 2 years, 3 years, 4 years. So the issue is these are it only applies to very illiquid things because, and also very hard to value things. And essentially what happens is the models that people create can value these things however they want, and there's really no way to check it either. Even though the stocks are, like I said, the capital gains aspect of stocks are Ponzi in nature, the good news is we kind of have to record what they are today, tomorrow, when it actually, as time goes on every single day. The problem with accrual accounting is we kind of, the way they use it is they just assume that it's going to achieve a price in a future date, and they just start recording it. And without any liquidity, and these are really, really esoteric assets and that no one really reports prices for, the fund manager or whomever is involved can essentially just use their own accounting books or using their own models to value these things. And all the auditors will do is go to their office and say, how did you get this value? And you say, oh, I got it from my model right here. And they'll say, oh, okay, cool. And then that's it. Because there's no way to check it. I mean, for accrual, really a lot of people, when they use accrual accounting, they're doing it for an asset that's not liquid. So there's no way to really check whether or not the model is right or wrong, because they don't really have an equivalent asset to compare it to out there in the market. So a lot of these auditors, when they audit these hedge funds that use accrual accounting, what they're really doing is making sure that their valuation models are essentially the numbers in their own valuation models are put in the right place in their own books. Okay, that's it. They're not actually saying, hey, their valuation is way off from what we believe to be valuation. They're actually just making sure they're just putting the right numbers in the right slots according to their own books and assumptions.
Okay. So I think one of the things you also mentioned in your book is one of the companies that you worked for, as you were discovering how this all worked, had actually changed their internal rate of return assumption on their investment, which actually changed the value of the investment using one of these methods. Can you talk a little bit about that?
Sure. Basically, the models that we used were used to model and project these values of the assets we were holding. So one way you can easily increase the net present value of an asset is just to reduce your internal rate of return. So the lower you set the numbers, because the internal rate of return is an assumption. You're assuming that an investor who buys this asset is going to buy it with, let's say, 10% internal rate of return assumption. Well, with 10% internal rate of return assumption, your net present value of how much that asset is worth is going to be, let's say, A. But if you lower that assumption, okay, if you assume, well, no, maybe, investors aren't really interested in 10%. Maybe the future buyer is really interested in 8%. Yeah. Well, if you drop to 8%, then the price is going to rise from A. So the point is, you can literally adjust this number, which is kind of what we did, and make your net present value of whatever it is you're valuing increase.
Okay. One of the things that you mentioned before that I really wanted to touch on is ownership of stocks and who's responsible for paying that, whatever the value is we think we have. So, for example, we own a share of stock and it's worth $200. Who actually is going to pay you for that stock if you go to sell it? I think you said that mostly, if you're in a normal market where you're not having any sort of major issues and everybody's trying to exit, a lot of times you can go to market and sell it to the next person. But what about the company that issued the stock? Do they have any responsibility from your experience in having to pay the investor for that? Or is it just purely on what the market will bear at any given time?
You mean whether or not, let's say, Google has to buy back their stocks at the market price? Is that what?
Yeah, exactly. I think you mentioned essentially in your interviews that you went through some SEC documents, and it was interesting to find what responsibility the company actually had for the shares that it issues.
Yeah, so no, from experience and also just what we can recognize, Google, I will mention that they announced a buyback of 5 million shares in 2016. That same year, their shares outstanding also increased by 3 million. Okay, so a lot of people talk about buybacks. They don't pay attention to the dilution. So a lot of these buybacks are actually scams, and they just tend to issue shares right before and after. Not all buybacks are scams, I will mention. Apple has been buying back their stocks and it's been decreasing, but a lot of them are. But as far as responsibility goes, do they have a responsibility to pay their shareholders? In practice, what we can clearly see from Berkshire and Google and many others, the answer is no, they don't. Even if there's some language in their SEC documents that kind of says, yeah, we have a responsibility of returning money to our shareholders, it will be also accompanied with a bunch of conditions under like this, if that, a bunch of hypothetical. And of course, lawyers and whoever they have can always use those conditions to justify, yeah, it wasn't a good year, we're not going to pay investors. Oh yeah, we had to reinvest this money this year, it's for this, so therefore we're not going to pay them. So there's all these excuses. Is there anything definitive saying that they'll actually pay back their investors, that they back the value of their stock? No, not at all. They have a par value, which is in front of the SEC filings. Everyone has this in front of their SEC filings. And for Google A and C shares, the par value is $0.001. So a tenth of a cent. And this is the case for, I believe, all public companies. I think Berkshire A shares might have a par value of $5, which is, compared to, I think, what is it, a couple $100,000 in the market price right now. So gives you an idea of what the definitively monetary backing they have for their stocks.
Okay. So I guess once you started figuring this out, what did you do next? I mean, what I know you wrote the book, but what are you doing? Are you invested in the market, or have you completely changed your focus?
No, I'm not. I don't touch Ponzi assets. Right now, the focus is with respect to just getting the truth out there and just doing more research on some of these aspects. Right now, as far as like what I'm invested in, look, the safest thing is to go real estate. I'm not saying I'm invested in real estate, but the safest thing is that, but I understand the barriers to entry for that are high too, so it deters some people. I know someone that asked a funny question once, or actually told me something funny. Said him and his friends were talking. They said, "How many people do you know that got rich from real estate?" They named a bunch of people that they knew. And then they said, "How many people do you know that got rich from the stock market and kept it?" Okay, and kept it. And then they were like, So point is, the safer way is to go is real estate. But I will also mention that there are some decent dividend stocks out there too, which people can look for. Verizon, for example, pays about 4%, or has been paying about 4% dividend yield, and it's also a pretty strong company. So then when in those situations, there is clearly a monetary connection between the company itself and the shares. So at that point, the fundamental research and that stuff, that plays a bigger role. In fact, that plays a real role versus the fundamental research about earnings and shares for a company that's never going to pay any of those earnings to any of the shares is all speculative research. It has nothing definitive, nothing mathematical, nothing logical. Versus the dividend ones. Verizon's one. I think Duke Energy is another one that pays some decent dividends too. So there are some out there that aren't bad, aren't terrible if people really want to get involved in the stocks. But definitely the Ponzi assets that pay nothing to the investors and nothing more than just speculating the price increase. Yeah, that's called a Ponzi scheme. Those are Ponzi assets, and they meet the definition of a Ponzi scheme.
Okay. I think you also talked about some valuation metrics in your book, and I'm in the process of going through the book. I haven't completed it, but I'm about 2/3 of the way through. And you talk about, for instance, Black-Scholes. And Can you speak a little bit about the validity of Black-Scholes and what it does?
Well, Black-Scholes in general is meant to value options or price options. Nobel Prize people, of course, they got the people who developed it won Nobel Prizes. And the whole thing about just financial research and valuation, like Black-Scholes formula and pretty much every published finance idea out there, is that they assume stocks are positive sum, which is they assume that stocks are investment instruments to begin with. So they assume, okay, cool, stocks are investment instruments. And on top of that, we have these things called options, which are contracts and insurance policies for certain stocks for certain price movements. So let's develop a model to price these options contracts. Well, the problem is they're assuming that stocks are positive sum, they're investment instruments, they're not gambling instruments, and they're developing these ideas on top of it. And what I basically point out is, well, if first of all, no one knows what the equity returns are. There's no database that keeps track of investor losses, and this is actually a big unknown area in financial research that's embedded in equity risk premium research. So the assumption is for the Black-Scholes is we have a foundation that says stock market is positive sum in its investment system. Let's build something on top of it. The problem I point out is your assumption is a massive one. Furthermore, I can show you why it's probably not positive sum. So if you can show that the foundation of the system is not even an investment system, that no one knows what the probability of winning or losing is. Furthermore, by design, capital gains are negative sum in practice. Any idea that's built on top of that, whether it's Black-Scholes, whether it's whatever formula that's coming out of UCLA or some business school or Harvard, they're worthless. Worthless because a foundation is not there. They're assuming these models are relevant because they're assuming the foundation's there. But they're worthless if the foundation's not there and that the probability of winning on black and roulette is in fact better than the probability of winning on some given stock in the market.
Okay. And I know you mentioned real estate there for a moment, and I think you've used the example before that you still have your real estate, even if prices move up and down, you still have a tangible asset. And that's different than the stock market where if the price crashes, it's really just a piece of paper. I mean, it has no intrinsic value in and of itself. And you mentioned bonds before, and I think you mentioned bank account. So there are some differences in types of investments. I wonder
Mm-hmm.
what your thoughts were on bonds. Do you have any thoughts on bonds at all? How do you see those? Do you think that they're real tangible investments there? And is that a,
Yeah.
or, you put money in the past, or do you have any experience with that?
No, I mean, look, at the end of the day, the bonds, right? There's a promise of repayment. It's literally a loan. So it is legitimate. Whether or not the lender or the borrower is credible or not, that's something subjective. People can research. But the point is, when people invest in a bond, they're getting the interest rate. It's pretty straightforward. As in, yeah, they're borrowing your money and they're going to pay you back. Equities and stocks, the problem is they're borrowing your money and they're not going to pay you back, or there's nothing that they're not saying that they're going to pay you back, and there's no way of knowing whether or not they'll pay you back. And they're just saying, hey, we call that equity. Hey, you own a piece of a company. Hey, we're not going to pay you, but you own a piece of a company. Yeah, cool. No, bonds, at least there is a monetary connection. Bonds, at least there is a promise of repayment. So I don't think bonds are illegitimate instruments. I would say that they are legitimate instruments, but you have to do your research with respect to the credibility of the company and their likelihood of fulfilling their promise of repaying you.
Yeah. In terms of ownership of a company, that's something that I was taught in my accounting classes in college, is that the stockholders are the owners of the company, and they can either vote individually, or if they're small owners, a lot of times they vote by proxy. They'll mail in something that says, I want to vote this way, and those votes are tabulated at the periodic meetings. So if you're an individual investor, you could say, well, if we wanted dividends, we could vote them in, or we can vote on the direction of the company if we don't think that management is acting in the way that we want. Can you talk a little bit about true ownership of stocks for the individual investor?
Yeah, so voting itself is complete garbage. Now, is voting better than not voting, as in Google Class C shares have no votes versus their A shares that have votes? Sure, we could say that the A shares having a vote is better than not having a vote, but in general, it's complete garbage. First of all, price-wise, if you look at Google, the difference between Google A shares and C shares, the difference in price is somewhere like 0.5%. So basically, monetarily wise, no one cares about voting either. The biggest issue with the whole voting idea and why people should not assume that's what defines equity is because these companies can and often do manipulate votes. They can easily print more votes. Tesla's shares have almost doubled since 2011. Jeff Bezos also printed, I think, 131 million votes over the past 15 years or so. So voting only works if we actually have a set of votes. For example, I'm launching a company and I've got 1,000 shares, and this is 1,000 shares of the company. And that's cool. And basically, I'm going to sell this to public investors, and everyone has a voice. Yeah, in that situation, it works. But the problem is, it's like the way it actually works is, hey, I have a public company, I got 1,000 shares, and if it doesn't quite work out, I'm going to print another 1,000, and then I'll print another 500. And that's actually the reality of what actually happens. So the whole voting thing is totally, it doesn't work for the very simple reason that votes can often be manipulated. Second of all, the voting thing historically was never actually mentioned in terms of how it's essential to being equity or stocks. If you look at history before the 1900s, all stocks paid dividends. What made stocks equity ownership instruments was this definitive monetary connection between the revenues of the company or the profits of the company and the shareholders. There was a profit-sharing agreement between the shareholders and the companies they owned. Voting historically, based on what I read, was never even mentioned in the history books on stocks. Now it's very possible, and I wouldn't be surprised if the very first stocks didn't even have voting rights and wasn't even democratic, because initially stocks came about in the 1600s because of a silent ownership type of thing, because it was in the shipping industry where there was a serious separation between the voyages that these ships will go on and the silent partners back in England that provided money for these voyages. So there was a serious separation between hands-on business work and the funding aspects. So what investors ultimately care about, and what investors should continue to care about, is whether or not there's a monetary connection, whether or not they're going to receive money in this profit-sharing agreement with the company. The votes themselves is from what I can see, is really just an ornamental argument that finance people like to gravitate on now to basically make excuses for how it's ownership, even though the owners don't receive any money from the companies they own. And furthermore, a lot of these votes, okay, yeah, if people can't vote for change, all this stuff, it's totally hypothetical. And you can't exactly use a hypothetical scenario like what Google shareholders could do if they organized and sued the company, and what Google might do in the future to debate the observable fact that the only foreseeable way Google shareholders will receive money for the companies for the shares they own is by selling it to another investor. The Ponzi aspect, the Ponzi process, is an observable scenario, and you can't use a hypothetical scenario like what would happen if the shareholders colluded and sued Google to debate something that is clearly observable.
Okay. And so what about solutions? What are solutions to this? Because it seems as though a lot of the original intent of a lot of investments and a lot of law that was laid down early in our country's founding has sort of been lost in favor of a lot of speculation. And how I first saw this is I was working for a currency broker for a period of time, and I got my Series 3 license, and Series 3 is around commodities. Mm-hmm. And we were taught during those license classes that if you're going to invest in a commodity, you have the producers, and then you have the hedgers, people that may use that commodity, and each one of them wants to hedge their price, right? Mm-hmm. And so they go to markets to hedge their price. So, for example, if you're producing corn, if you think the price is going to fall, you may hedge that a little bit. Or if you're going to use the corn and you're going to produce something with the corn, or you're going to sell the corn at market, as a distributor, you may hedge the price also to reduce some of your risk between the time that corn's in the ground growing and the time it gets to market. But what has happened in the commodities market, and it's seeming like all markets, is the speculators have sort of taken over. And so now we have this sort of speculative overhang over a lot of our markets. Yeah, driving prices maybe that aren't based on original tangible value. So what solutions, from the stock market perspective, what solutions do you see that can rectify this problem that you're describing?
Yeah, from what I kind of see is, one, the dividend stocks, where the legitimate ones, there's less speculation on them. I'm not saying there isn't, but there's less speculation. And even if there are speculation on there, it's still a legitimate equity instrument if there's a monetary connection. Now, it's really the I wouldn't even call it a startup. Some people say, oh, Tesla's a startup. Dude, it's not a startup, all right? It's 16 years old, all right? They're just calling it a startup because they haven't made any money yet, or they're still having a hard time. So a lot of the speculation are these actually kind of like new tech company type of things. So some people have said, hey, wouldn't that destroy the capital markets for startups and stuff? Well, if they're running Ponzi schemes, one, it doesn't matter if it is destroyed. They should be issuing bonds then, right? But two, I actually do have a better proposal for that, perhaps. If a company like Tesla, or I don't like to use Tesla, again, they're a mature company now, but if a new startup company from Silicon Valley wants to issue stocks, what we should have a regulation on is, sure, sell your stocks, sell as many shares as you want to people who believe in your company. But we're not going to let you trade. We're not going to let you speculate it. We're not going to let you Ponzi up that $20 share to $380 based on speculation alone, even though you're never going to pay them, and even though we don't know if you're ever going to pay them, and you're continuing to lose money on a regular basis. So I suggest that for startup companies, they can still use stocks to raise money, but their shares should not be allowed to be traded, and it's only when they pay dividends. When that stock becomes a legitimate equity instrument because they're paying their shareholders, that's when we'll put it in the market and allow people to actually trade what is really equity.
Okay. So it sounds like there's both maybe a legal and accounting component. Legally, we have to set rules about what people can do. And then from an accounting perspective, there needs to be work done to help people appropriately value assets within the legal context. And so we probably need work in both areas, right?
Yeah, definitely. And I mean, we also need to correct the market cap formula, but good luck.
Right. No, I've been guilty of using market cap before, but then I think, we all learn lessons as we go along. And I think what I've learned is, you go through investment courses and even classes in college, but also, out in the real world, you try to follow the people that have done it before you because you think, well, they know what they're doing, right?
Yeah, and also the whole market cap. I mean, I've kind of asked a couple people about this as well, and even you. I mean, I kind of explained, and we could see how it's flawed. You can't apply the price you obtain from 1% of shares to 100% of shares, right? But imagine what would happen if we corrected this. I'm just, kind of curious what your perspective is too. What do you think? Would they correct it, right? First of all, because if you corrected it, you would see a serious decrease, like $34 trillion market cap go to what, like one or something like that, right?
No, that's a good point because, and one of the points I think you make is there's 34 trillion market cap of the market, but there's only 1.6 trillion of actual U.S. dollars in circulation.
Yes.
That are available. So there's a disconnect there, and it's like, okay, where is that other value going to be to pay for all this stock market? Is it going to be additional currency that has to be printed, or is there going to be a devaluation? And that's very interesting because one of the things that I wrote in my book in 2010 was we're going to have another crash. Real quickly, the reason I wrote that in 2008, I was working for Ernst & Young and in public accounting, but I was more on the tech side, but I was asked to do a business engagement, and I led 23 people on an engagement for Morgan Stanley, and they had bought one of these mortgage origination companies that had gone defunct. It was a company called Novastar. And they had 53,000 mortgages that they needed to service, but Novastar was going out of business because they really didn't make enough money. And I kind of saw the system from the inside, and I kind of woke up and said, wait a minute, we've got issues with real estate, right? And I think and that's one of the genesis of me writing the book was I started to see things from the inside, and I started doing my own research. And I'm like, okay, wait a minute, something's not as it seems. And what I said in my book is I think we're going to have another crash. But at some point, and it could be in the next few years, we're in the midst of a 10-year bull stock market. Historically, about every 4 to 10 years, we'll have a recession. But so often we'll have a really big depression or a deep recession. And I think whenever that next deep recession or depression happens, I think what's going to happen is people are going to wake up to this overvaluation. And I think it's going to crash down. And I don't know what the number is going to be. But I think that would be the opportunity for the people to demand the lawmakers to actually change the rules because, and it should have been, these are things that should have happened during the Great Depression, and we put some laws into place and then we were, and then we loosened them again, right?
Yeah.
So we're going to have to go back to where the laws are in place to prevent this overvaluation. But I think it's going to happen on the heels of the next big crash, whenever that big crash comes. Because I think right now people are afraid that their 401ks and their pensions and their IRAs, if the market were truly valued right now, people would lose their retirements. I don't think they want to do it. I think the crash is going to have to happen first. They're going to come in and say, okay, let's put rules around not letting this happen again.
Yeah. It's funny though. I actually spoke with I went to a roundtable meeting with the SEC chairman and commissioners, and a lot of people there were kind of like the people who were at the meeting that weren't with the SEC. They were talking about how, they wish the language would be simpler. They wish the rules would be simpler, especially with fiduciary duties and financial people. And I said, hey, I have a simple thing you could put on top of every financial document that clears everything up. That's $34 trillion equals $0 in real money. That's all you need, okay, to clear things up and disclose the truth. Everyone started laughing, and then and I said, yeah, but it's true, right? It's true, and they acknowledge that it's true. And the chairman, Clayton, he said, yes, but let's try to find something less binary. That was his response.
No lawmaker is going to want to go to the public and say, hey, we got to revalue your assets.
Yeah. And the thing is, I didn't even say, let's revalue it. I simply said, how about we just put this fact right on top of every document for financial advisors, which is, this is how much stocks, $34 trillion in stock value equals $0. That's all that's just a simple fact, real. Just put it on top of it. But that was his response. Let's think of something less binary.
No, I agree. Adding transparency to the process and maybe changing the rules. And, because I think we were both taught in school this system, and then we're kind of getting out in the real world, and it's like, wait a minute, this is really not how things should be working. So, but I think it'd be painful to a lot of the solutions we could propose would be painful, and so how do you tell people that their investments aren't worth what they think they are? So that's what I kind of try to do with my newsletter. I try to help people move into safer assets, ahead of whatever the next recession is, so that they don't. What happens when you have a recession? People don't want to get out because they're like, well, I lost 30 or 40%. I need to get it back, right? Because if I don't, I can't retire. But what I'm trying to help people do with my newsletter is get people into safer assets that tend to hold their value over time. State would be one of those, especially like farmland or ranch land tends to do very well. Gold, silver are alternatives. Anything that historically is safe. And hopefully enough people will do that to where the next recession comes, it doesn't hurt so many people.
Yeah, exactly. Because the things you're talking about, farmland, gold, silver, look, those all have one thing in common that's very different from stocks. They're somewhat finite things. They take resources and stuff like that to replicate if it can be replicated, right? Versus stocks, dilution. Basically, it's just imaginary assets that anyone can print and print as many as they want. So it's fundamentally different. The things the safer assets you're talking about.
Yeah, I think safety is go to things that have limited supply and have been valued consistently over very, very long periods of time. I think gold, silver, real estate all sort of fall into that territory. Yeah. All right. Anything else that you want to talk about related to your book, The Ponzi Factor, or anything else that you've got coming out that people need to look out for?
Just that regardless of where they fall on this issue and what we talked about, I seriously encourage them to at least go on YouTube and listen to the introduction of the book. At the end of the day, I don't really care whether or not people want to gamble on Ponzi assets or just become a wiser investor to get out of what I'm calling a Ponzi scheme. At the end of the day, I just want them to know the truth. I don't really care what their goal is. So I seriously encourage them to at least look at the introduction wherever they fall on this issue.
Yeah, no, I definitely appreciate that. And your website, I believe, is theponzifactor.com, right?
Yes.
Okay, great. Thank you so much for your time. I do appreciate all the time you give into the interview. I appreciate all your research, and I appreciate you coming out and telling people this, because I think there are a lot of people that may suspect the same thing as you and they don't talk about it in public, but I think it's very helpful to have these conversations. So I do appreciate you doing that.
Yeah, thank you, Rob. No, I appreciate it too.
This has been a Gold Silver Pros production. Please subscribe to us on YouTube and sign up for our newsletter on goldsilverpros.com.